Last week was the conclusion to the concerns being brought up on social media about IUL. Be sure to check that out as we addressed those this week. We're talking whole life versus IUL for infinite banking purposes. It's a clash of the titans. You're going to have people out there arguing for one or the other. We happen to like them both, of course, and we're going to talk about how these things compare for infinite banking purposes. So hopefully that'll help you out. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
My name's Jing with Tax Exempt Millionaire Club.
Hi, and I'm Carlo with NetWealth Finance.
Appreciate you joining us again this week. This is the battle of the titans in the infinite banking space, meaning there's a whole lot of people that advocate for whole life for doing infinite banking and a whole lot of people who advocate for IUL in the infinite banking space. Let's just kind of jump right into it. I know I think among all of us, we have both whole life and IUL that we could potentially practice some infinite banking. We'll get into that in our personal stories about it. But let's start with, what do you guys hear as arguments for why whole life is the thing to use for infinite banking?
When it comes to whole life, one word comes often, which is the guarantee. For a lot of people who practice IBC, people talking about using whole life because all the guarantees it offers.
And I think that's one of the reasons why a lot of people and the original infinite banking concept was really built around whole life. Having those guarantees, being a really solid growth vehicle, is a powerful thing for something like an infinite banking policy, because you know that it's going to continue to grow and you should be able to borrow against it. And it's a pretty solid growth vehicle. It's not going to be the highest. So there's a lot of people in this space. Actually, I would say most of the people in this space will say that you can only do this with whole life. So I don't happen to agree with that, but that is what you'll hear a lot.
I'm going to take a little different approach, because what I hear out there around the argument for whole life in relation to what particular product should be used, a lot of it has to do with Nelson Nash and that he used whole life policies to do it. And when I look at that, he started doing this back before IUL even existed. It wasn't even a thing. And he owned traditional whole life policies, which we would never design or sell today for infinite banking purposes due to the high expenses and the really long recovery period when it comes to putting your funds in and having those funds again be available. But Nelson Nash, even after IUL came out, never warmed up to those types of policies. And he lived through a time where universal life became popular. And of course, it had its problems and how it was sold and the different things that happened within that. And then the same thing in the IUL space, where it may not have been sold properly or designed properly. And so a lot of people had problems in that. And I think that Nelson and the practitioners of infinite banking, people who call themselves, infinite banking specialists or infinite banking approved, they're going from the Nelson Nash school of thought, which is the guarantees on whole life are the main backbone of why whole life is used for doing that. Do you guys kind of hear the same thing, or is there anything else to add with regard to why whole life might be the choice?
I do hear those same things. And I think one of the things that I would say to that, when we're talking about the guarantees in whole life, if we truly just rely on what is guaranteed in terms of the growth rate in whole life, it's not really great. And also, the time in which Nelson Nash wrote his book and started doing this concept was a very different interest rate environment. I don't know that we'll see it again. These types of policies having 8, 10, even up to 12% gross dividend rates, I think that's a very different time. So you hear about that a lot from various people in the infinite banking space. Look to Nelson Nash, but I'm of the mind that as times change, as products changed, I think we have a lot of other great options within the IUL space as well.
Yeah, whole life, I don't have anything against whole life and it being used for infinite banking. In fact, I have a couple of very large whole life policies that I use for infinite banking that were the backbone of the start of what I consider to be my bank, my banking system. I also have some small policies, whole life policies, that also kind of serve the same purpose. But then I also own some IUL that I utilize the same way. And from my perspective, we get a really good diversified opportunity when we utilize both of these things for doing infinite banking, or when we have access to both types of policies because of the different things that they offer. Now, the really attractive feature from whole life for the infinite banking space is those guarantees. And also, I would add the safety and peace of mind that comes from storing money inside those. You really just don't have to think about it. They're going to grow every single year as long as we have a good mutual company. We're going to get beyond those guaranteed rates. And I think the biggest comfort when it comes to the guarantees is not that if we only got the guarantee, it wouldn't do well, but that's absolute worst case scenario. And it's nice knowing that that absolute worst case scenario is, it's still okay.
Well, one argument I heard someone said the statement for whole life versus IUL, he will not put a penny into IUL. I think for people with that strong argument, they probably did not really drill down and compare side by side with the guarantee, the flexibility, and a lot of things we were talking about for both. We could use both. It's just the suitability for each of the product at each person's situation.
Yeah, I think the IUL brings a lot to the table that didn't exist when Nelson Nash first started this. And I look at it as an evolution. Whole life insurance, or life insurance in general, had to evolve in order to compete in the space for where people have to decide to put their money. At some point, whole life just wasn't as attractive as the stock market. And there's so much money in our whole entire ecosystem that's focused on getting people to invest in the stock market that you just can't avoid it. And insurance companies were having trouble staying viable by only offering whole life. And so they had to expand their offering. They had to evolve. They came out with variable universal life, and then ultimately they came out with the IUL because there was a demand for people wanting the innovation that gives them the protection of life insurance, but better potential returns than what whole life was offering. And I don't see anything inherently bad about that. Whereas a lot of people will talk about whole life as being the only option, either because that's what they want to sell, that works for them for marketing purposes, or they just don't understand why somebody might be attracted to the IUL in the first place. And there could be some legitimate reasons why somebody might choose to own an IUL policy, even outside of the infinite banking space. And then if you own these policies, can they work for infinite banking? And I think the answer to that is an emphatic yes. If you already own these policies, you can certainly do infinite banking with either one and have success with it. Let's do a quick reminder. Why do people own infinite banking policies? What is the reason to get into infinite banking?
I think for me, I want to build up that bank. I can access the bank. I can access the cash value inside of my bank. I can invest in real estate, invest in buying and selling companies. So I can skip that application process to get a loan from the bank. And I take full control. And then there's also, because it's an IBC, it's a life specially designed life insurance policy, I also enjoy all the tax benefits.
So the biggest thing for you is getting access to that money without having to go through a complicated application process or worry about being rejected.
Exactly. The speed and the control.
Yeah. So in that case, either type of policy, whole life or IUL, both fit that bill because you have guaranteed access to that cash value via policy loans from the insurance company.
And I would add, when I think about either of these products and this infinite banking concept, it's similar to what Jing said. I want to have access to liquidity and lock out, but I also want to lock in compound interest gains pretty securely over time. On the whole life side, you're going to have those guaranteed gains. On the IUL side, you have that zero as your hero or maybe a small guarantee, and locking in those gains while not losing access to that liquidity. But also, these are great vehicles for putting a ton of money away for your savings. There's not really comparable vehicles that you can do the amounts of money that I do personally. And I think that's a reality of life insurance. It can be designed to put really high amounts of money into these policies and lock in those compound interest gains on it.
Yeah, both can work really good for being able to set aside money. IUL tends to have a little more space available for the amount of death benefit and how long we can fund them at a really high level with a really low expense design. So I think the IUL beats whole life in that particular scenario, disregarding any of the other differences between the two. Just sheer amount of money that we can put into a policy in relation to the expenses, I would put the IUL on top. What do you guys think?
I would agree that is the case, but I would also say that 99% of people, it's probably not going to matter for their purposes because we're talking about very, very high amounts of money. But I think that is true. And if you want, especially if you're younger and you have a lot of money to put away, I think it's a fantastic vehicle for that purpose. And there are certain whole life policies that can have pretty solid, like my own policy is a pretty high long funding period. But in my own whole life policy, for putting similar amounts of money into it versus my IUL, I do have significantly more death benefit. Probably about 50% more death benefit was the starting amount than in my IUL.
And that's really what I was getting at, was I think when we're comparing apples to apples and trying to get money into a policy, it's a little less expensive to do it inside a properly designed IUL as opposed to a properly designed whole life, because some of the limitations that come about when we do certain designs on whole lives. And if we're not doing the specially designed on whole life, the expenses can really balloon out of control. Okay, so let's pivot just a little bit in the discussion to whole life versus IUL when it comes to actually taking loans from the policy to go do our banking, to go do our other investments. How do they differ?
Well, it depends on the carrier, right? The interest rate is determined for the loan. So when you take the loan out from your cash value, either whole life or IUL, the process should be almost the same. The interest rate will be a little different.
So for me, when I think about how I'm going to take a loan, I will actually lean into my IUL first because I have a fixed cost to borrow, which is a pretty decent rate of 5%. And I'm using that indexed feature, so I'm not impacting the compounding in my own policy. So that I personally, with my own policy, will tend to prefer borrowing from my IUL first. And in my whole life policy, it is a direct recognition policy. So I do have my dividend adjusted when I have funds that are borrowed. And so with that, I not only am I paying the rate that I'm paying, but I am reducing slightly, a 0.65 for the first 10 years. It will be a wash after that, but I'm basically losing a 0.65 of the dividend. So that is a factor when I do my own policies. Not all whole life policies will have that, but that is a consideration of direct recognition versus non-direct recognition. And we have some other episodes where we dig more into the details of what that is.
So let me circle back to Jing's comment and expand on that. Essentially, what she was getting at was loans can be different between whole life and IUL, the loan options. And then Carlo let us know about the specifics between a couple of his policies. So let's talk a little bit more in generalities here. Usually in the whole life space, you either have a direct recognition loan or a non-direct recognition loan. The direct recognition is going to impact the dividend payout in some way against the cash that you've borrowed. It may reduce it. Most cases, it will reduce it. In some cases, it may give you a higher amount than the current dividend rate. We won't see that in today's interest rate environment, but there were a few years back that was the case in some particular policies. Also, the policy loans could be a varying rate or they could be a set rate for the life of the policy. There's also non-direct recognition, which means they're going to ignore that you have a loan. You're just going to pay whatever the loan interest is, and they'll give you whatever the dividend rate is. That could be good or bad because some carriers that offer that have a higher dividend rate than the current loan rates, and some of them have a much higher loan rate than the current dividend rate, and they're variable. So you may not know what you're going to get from year to year. To me, that adds a level of variability that kind of makes me a little bit uncomfortable. So I generally try to avoid those types of policies and those loans. If I'm going to have a large outstanding loan, I don't want to get charged 5% one year and 7 or 8% the next year. That's a lot of variability inside of a particular loan option. I prefer the fixed loan costs. And this is where the IUL steps in and offers you a couple of different loan types, sometimes 3 different loan types, but you generally have the ability to choose participating index loan, which is similar to a non-direct recognition, or a fixed loan, which is similar to the wash loan that's available in a direct recognition whole life policy. We have both of those options available in the IULs, not with every single product, but with most products, and you get to choose in any given year which loan type you want to have. And there's some carriers that will let you carry both loan types at the same time. Now, all of the loans act like lines of credit. They're great. That's why we like these for infinite banking purposes. But I think it's important to understand that there's definitely differences between opportunities to borrow between IULs and whole life. And that was where I liked the option of choosing both. If you own both, you could just go to whichever one is either has the less impact, either has the least impact, or is the lowest cost to borrow from at any given time.
That's exactly how I like to think of it. And it just happens that in my policies, my IUL will tend to be the preferred option for now. I think once I am into the wash loan on my whole life policy, it may be a little bit different for my particular situation. But I think the reality is I don't necessarily select the product on just the loan terms for either of these things. I want to see good growth in these policies, and I think that's the main thing. And all of the products that we like to work with will tend to have some pretty great options for loans, whether that's in the whole life or IUL space.
Let's wrap this topic up with one of the major complaints that we tend to hear when people complain about the IUL in regard to infinite banking. And we're usually hearing these complaints from people who are pitching whole life as the optimal choice for infinite banking. Now, I don't have an issue with whole life for infinite banking. I think it's just fine. But the argument that they like to make is that the expenses are going to get too expensive in the IUL and your policy could lapse in the future. And this is some major risk that you just don't want to be exposed to when you're doing infinite banking. Do you think that argument holds water?
Well, it's all about design, and it's also when the policy is sold as a consumer, you need to know a little bit more instead of just listen to what the insurance agent is talking about. You need to know for your IUL policy, you need to take a little bit care instead of just whole life. You can just pull the money into your policy and let it sit, and you don't need to do anything. A lot of features are guaranteed. I think it has to do with the policy design, and then the consumer has to learn this IBC a little bit more instead of just blindly accepting that argument, saying the expense of IUL is very, very expensive. In IUL, you really need to manage your expenses.
Yes, and there's really a few things that you should be ready to do when you stop funding an IUL. One is switch from an increasing death benefit to a level death benefit, and make sure that you adjust down to the guideline minimum premium or guideline minimum death benefit. And what that's going to do is, especially if you've funded it for a long time, you will have significantly more cash value than your expenses, and that credit that you could have, you could even have the guaranteed rate in your IUL. If you have a guaranteed, let's say 1%, that could cover all of the expenses in that policy if you've grown enough cash value. So I think it's not a huge concern if properly managed, properly designed, and properly funded.
Yeah, you guys both hit it on the head. Realistically, when you manage those expenses after you stop funding it in an IUL by reducing the death benefit to the minimum required, we should see an insurance expense well below 0.5%, oftentimes around 0.1% of the cash value in the policy. Those policies are not going to lapse if you have such a tiny expense built into that policy. And you could utilize the fixed interest account. You don't even need to be tied to the index options at that point. If you wanted to do the equivalent of like a reduced paid up in whole life, where you don't want the policy to lapse, but you don't want to put any new money into it, that's kind of like the equivalent way of doing that. It's going to continue to grow because most fixed accounts are going to have a 2% minimum. It might even be higher than that, depending on the product. And your expenses are so much lower than that. So the idea that the IUL is bad because the cost of insurance can just get out of control, it kind of is possible in a bad designed or poorly funded policy that could happen. But realistically, if you do the proper education, you listen to our videos, you get a good design, and you understand how to manage the expenses in the future by just making those 2 small changes, it's not anything you have to worry about as far as the policy lapsing because of that rising cost of insurance.
And I would add too, that there are, and I think it is one of the unfortunate realities, that there are a lot of people who get improperly designed policies. And I have known some people who have gone a long time and funded the policy close to what would be the minimum on a poorly designed policy. So you can have that circumstance, but that is not what we're talking about here. When properly designed and properly funded, an IUL should grow to have cash value that can easily cover the expenses in those late years.
All right, I think final verdict, all of us are probably on board with both of those being viable options in the infinite banking space. You can utilize either one. Just make sure that you're working with an agent that can help you navigate the ownership of those policies. Would you agree?
Absolutely.
Definitely.
With that said, do either of you have a call to action for our listeners this week? It's time for this week's call to action.
I would encourage the audience to explain this themselves. Try to say, okay, what is the benefit to using whole life versus what's the benefit to use IUL? People saying the more you know, the best way to understand a concept is to teach it. Just try to explain it yourself. You'll find out what's the best way for your particular situation at that moment. Maybe you can switch to multiple IUL policies if you think whole life right now is the better situation, vice versa.
So I think that if you fall into one of these camps where you're all in on one or the other, like I know lots of people who are like that, I'd say check out some of, I have content on this, James has content on this, there's various content creators. Review the content on both sides of this argument. I think that there's strong points on both sides, but if you are uncertain after seeing that, get in touch with one of us, book a meeting, and get an illustration for both and see how they could look for your situation.
And I would recommend that you just talk to multiple agents. If you think that whole life might be the best option for your infinite banking policy, just have a conversation with somebody that understands the IUL very well and doesn't just hate on it, because they're going to have a little different perspective. And if they're really not biased one way or the other, like us, or we would go either way, whole life or IUL, depending on which actual product will meet your needs best, you're going to get an honest answer. And from there, you can make a good decision. So talk to multiple agents, get different inputs, and decide after you get that information which way to go. Don't just go with one agent who is biased one way or the other and only sells you on all the good of whatever particular product is their favorite. And with that, we're going to wrap up this week. Next week, we're going to do some more myth busting. The 5 most common misconceptions about high cash value life insurance. So be sure to join us then. Thank you for joining us this week. I'm your host. Thank you for joining us this week. My name is James Barber. I'm your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And my name's Jing. I'm the host of Tax Exempt Millionaire Club. You can scan the QR code and join that school community, SKOOL. We specialize to help people to transform into tax-exempt multimillionaires.
And my name is Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we will work with life insurance clients across the country.
Take care. We'll see you next week.
Thank you.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.